clients know, believe that they can come to you, then ultimately that's going to kind of help those customers and give them that flexibility that only you can offer as intermediaries. I think it's important to know as well, a lot of the specialists, they only, or generally speaking, don't have a direct workforce. They're not looking to steal your business. They are leaning on the intermediary market. So the more you understand what we can do, you then got a choice. You can start advertising what you can do. You can start putting blogs together about what you've done, how you can do it. All of these things to kind of really help and support your business and support clients coming to you. So again, I think with specialist lending, it's a great way of growing your business. It's a great way of kind of offering more opportunities for clients to seek you out. But equally speaking, if you've got an established business, then it's a case of like looking to see, right, actually, how can I add value to those existing customers of mine? And that could be residentially, it could be with the buy-to-let sector as well. So we try and cover a bit of that off. Just want to kind of just give you a bit of an indication of what's happened to where I work, how we've developed, if you like, as a brand. So back in October 2019, 3 major specialist lending brands merged and became part of the One Savings Bank group. So Precise Mortgages, Kent Reliance and Interbay Commercial all came together to form one. Now, from your perspective, from an intermediary's perspective, you've still got business development managers that work for Precise, work for Kent, work for Interbay, and will give you the best knowledge and support across those brands. From Becky's perspective and some of the guys at HLP as well, then ultimately I kind of look after all of those relationships. So if they feed back into me, then I can start feeding back up the line about what we can do better, how we can maybe improve, also what some of the other specialist lenders are doing as well. But what I think you will find is that you'll start seeing us do a little bit more across the brand. So tweaking little things here or there, moving the bars up. So can we do a bit more in bridging with Precise Mortgages, for instance? Or could we do a little bit more in, I don't know, more complex buy-to-let, semi-commercial stuff with Interbay? For you, might be a handoff to a packager or a distributor, but ultimately every kind of conversation with every customer is going to be good. Then we start looking at housing schemes, maybe where we can support shared ownership through Kent Reliance or Help to Buy through Precise. Again, what you're starting to see is that actually across our brands, we've got lots and lots of ways to support you. So I mentioned kind of where I think you fit in, and I think that the high street lender versus specialist is a really important journey for a customer. We're going to try and give you that help and support and advice to say, actually, we do things differently. We've got manual underwriting. We've got the ability to look at a case that might take a bit more time. We've got the ability to maybe not credit score, whereas a high street lender might be looking to get that simple answer, to get that client onto that fantastic high street rate. Again, that's where specialist lending can be a bit more expensive, but ultimately that could mean that that customer gets to their dream house or gets that remortgage to put them in a better financial position. All of kind of these ways of looking at it is really important. I think I even read last week, there's a bit in Money Supermarket have now kind of linked up with some of the high street lenders. So again, doing a little bit more to try and steal that business away from the intermediary side of the fence or side of the street in this case. And then we're not obviously looking to do that. We're always looking to work with you guys. And I think that's going to be an important growth of the direct part of the proposition with the high street lenders versus what we can do on the specialist side of the street. So I think for me, specialist lending, anything like this really. So it could be residential self-employed, it could be residential adverse credit, maybe credit impairment, and we'll cover a bit of that today. New build, I think, is a really interesting part of our industry. Lots of new build developments, absolutely, we know are kind of swallowed up by those in-house mortgage advisors. But again, you could have opportunities where you've had a conversation with someone that maybe can't or doesn't believe they can get onto the housing ladder. New build could very much need a solution, again, across shared ownership, across Help to Buy, where maybe they don't have a deposit or a small deposit. Is this a way of actually having that conversation and pushing them to something where they thought was unachievable? Some great websites out there as well. So the Share to Buy website, brilliant website for shared ownership. It will list new build properties, but it will also list second-hand properties as well. So again, giving you that opportunity to see, you could have, even with Kent Reliance, for instance, someone that's got no deposit. Kent Reliance, for instance, do 100% mortgages based on the share that they are buying. So I think already, what a thing to shout about within your websites or your blogs, that you've actually got access to lenders that are doing 100% lending. It's not very often that's going to happen. Does that customer even know they can access you to get those kind of deals? Then you like start looking at, right, have we got people that are looking to capital raise? Have you got maybe some problems with capital raising? So some of the high street lenders, for instance, do low. So what I'm trying to say, they're trying to do. They have caps on the amount that you can capital raise for debt consolidation. We don't have that at Precise Mortgages or Kent Reliance. So putting that person in a better financial position could be a really great solution. Then you start looking at the wonderfully, beautifully complicated world that is buy-to-let mortgages. So portfolio lending, limited company, which is a real growth in our industry. And then you look at how the regulator has looked to change the way that we offer buy-to-let mortgages, and also taxation for those personal ownership cases has made a major factor and a major difference to maybe pushing a client towards a limited company deal. And again, we're trying to make you fully aware of some of the opportunities that are there, but also making sure that you don't step across the line and giving advice where that should be coming from a tax advisor. Cover a lot more in that in the second session that we'll do with you, but ultimately we try and cover a little bit off as we go through. We've got some great property refurbishment deals, so that kind of what do I call it? The closed bridge, if you like. So the way of accessing bridging finance, but feeling comfortable that you've got an exit strategy in place. So I know from a HLP perspective, really from bridging, you're going to be passing it over to a packager, but it could be there's still opportunities to have those discussions, and it could be something you could maybe do via Precise Mortgages, but ultimately, if you need to pass it on, you've got that knowledge to do so. And then you look at short-term finance as well. So it could even be second charge lending, where maybe you've been declined a further advance, maybe can't get the loan amount that you require. Again, that's something that Precise can offer, something that, again, could lead to that customer having that conversation with you and you building that relationship to go. It doesn't matter if you're declined by your existing lender or you've been declined that further advance, you've got places to go, and that's why you're a brilliant advisor. So let's start with adverse credit. So an interesting part of the market, I always think it's probably where a lot of the specialist lenders started their journey. It doesn't matter anymore. I don't think anyway. I think it doesn't matter that if you earn 10,000, 110,000, you are probably going to come across someone that has had some blips, if you like, or has had problems with adverse credit. It could be they've got small CCJs, defaults. It could be they've been given parking fines for they weren't even aware of. It's now becoming more and more easy to get adverse credit. The stats show it, but 100,000 CCJs are issued every single month. We know that more and more people are leaning on debt. There was a real kind of shift of this. So at the start of lockdown, the start of the pandemic, people started giving their savings up, paying all their debts down. Now that unsecured to get has begun to kind of rise again. People have unfortunately been made redundant, maybe changed industries, maybe waiting for that income to increase a little bit further. We're now seeing unsecured debt at a record high. I think as well, debt management plans, a really interesting part of the marketplace. There's a lot of charities out there that will help clients that are in problems. And a debt management plan could be, again, a great solution to get out of that problem. How can we actually get someone away from all of those credit card loans and support them with one payment, for instance? You might come across clients that have begun to do that. There are more and more lenders beginning to lend to people with active debt management plans, or it could be they need to have paid that debt management plan off, or they're consolidating it as part of maybe a remortgage opportunity. So again, understanding what could happen with a debt management plan is really important. Again, just while we're talking about it, there are charities, as I mentioned, that will look at debt management plans, but there are also kind of commercial organisations that do that as well. You will get a totally different experience, totally different cost involved, and maybe the documentation that goes with it will be totally different as well. So just kind of be aware of it. And again, I think the biggest one for me on debt management plans, don't get them confused with an arrangement to pay. So arrangement to pay is absolutely is more where you as an individual have arranged a new payment, whereas the debt management plan is being arranged by somebody else. So again, there's different flexibility, different approaches, if you like, from the specialists out there, but also from the client's perspective. It's just understanding exactly what you've got, maybe looking at that credit file to see how we can actually support based on what they've told you versus in reality what's actually happened within that credit file. The good news ultimately is that there's been a 195% increase in mortgage sales to customers with impaired credit. Now that was right up to 2018. I think that's probably increased even further now. Lots of lenders out there that will support all sorts of credit. Lots of specialist lenders that will offer you fantastic rates, if you like, or not fantastic, depending on which way you look at it, to actually go, right, we're willing to take the risk on this particular client. but they're going to have to pay 5 or 6% to do so. But again, it could be, rather than looking the rate that's attached to it, is actually from a monthly perspective, are you still in a better position by doing that debt consolidation, for instance, or moving to a smaller property in order to get rid of those debts? Again, these are the types of conversations that could happen, and there's certainly more lenders that are getting more and more comfortable with this, certainly based on property prices being pretty stable at the moment. That's going to help as well. So then you start looking at credit scores and credit checks. The different ways that lenders or approach these is really interesting. So Precise Mortgages, for instance, they do an internal credit score. So you'll put that decision in principle into Precise Mortgages, and we will tell you whether there's a deal on the table or not. Now, at Kent Reliance, for instance, and there's other lenders that do this as well, they do a credit check. So all they're looking to see is what adverse credit has happened. Could be unsecured arrears, it could be debt management plans, it could be bankruptcies, it could be IVAs. Is it going to fit within that policy? But ultimately, it doesn't matter whether the score was, 100 out of 1,000 or it was 500. They're just looking to see whether it fits in that policy or not. So again, giving that flexibility to know, right, I've got a deal on the table, but their score is so bad, I need to be going to a lender that doesn't do a credit score. That's where maybe a Precise versus Kent Reliance conversation could happen. And again, there's other lenders that will look at this differently as well. So Equifax, Experian, different credit reference agencies out there that can really support with what you're looking to do. There's some that will show all 2 or 3 that are out there. They're all totally different scores. They look at totally different data. It could be even that the providers, so your lenders, your banks, your building societies, maybe only report to 1 or 2, not all 3, or maybe even just 1. And then therefore you're going to get a different score against one particular credit provider versus another one. So things to probably overcomplicate things, if you like. But equally, it's meaning that you as an advisor, if you know what's happening and how it's happening, that can really support work with that particular applicant that you've got in front of you. So again, other terminology you might hear with credit files is things like, is it a soft footprint or a hard footprint? So at both Precise and Kent Reliance, it's a soft footprint at decision in principle stage. So what that means is there's no hard footprint going against that particular client. You are not affecting their credit score in any way by trying to see if they can get a mortgage with Precise or Kent Reliance. Now, there are other lenders out there that absolutely, it could be a hard footprint at decision in principle stage. You've got someone that has got a pretty low score, and that could have another detrimental effect on that client. That might be something you consider before doing that decision in principle. I think other ways to look at credit reports, credit scoring, seeing what's on there, and I've got some examples in a minute, but just ask to get those credit reports in as part of your experience, if you like, or part of that journey with that particular client. Certainly there's plenty of companies out there that won't even do a decision in principle without that credit report in front of them. Like I say, Experian and Equifax probably the biggest 2 out there in terms of credit reference agencies that the majority will ask for or look at. Get that report in and see what you can do. You might, for the guys that maybe saw me last week, really interesting individual experience that I've had recently. So I pay about £2 or £3 a month to get my credit report, my own credit report. I hadn't looked at it for a very, very long time. And I thought, right, okay, I better have a look at it. One of my colleagues, he's currently moving into a new build property, and he's moved out of his existing residential into rented accommodation. So he moved out, and he said his credit report had dropped, or credit score, sorry, had dropped dramatically. So I thought, okay, right, I pay my money every month, better have a quick look, see what it's looking like. And ultimately, I was a bit disappointed. So I had a really big red marker against my voters roll status, which I thought was very, very strange. I knew I'd been voting, phoned up the local authority, and they said, yeah, absolutely, you're still on the voters roll at your correct address that I lived at for about 4 years now, 3.5, 4 years. And I thought, this is all a bit odd. So I phoned up Equifax and I said, this just isn't quite right. And they said they could amend it within 24 hours. So logged back in 24 hours later just to see what my credit report looked like. And it had gone up dramatically. So it had gone up 404 points in 24 hours just by amending that voters roll status. So a massive, massive jump, not because I'd updated my voters roll status. It was the fact that the credit reference agency hadn't updated it at their end. So I'm sure we've all been there. I'm sure we've all told clients, right, go and get yourself on the voters roll. I was already on it. What I hadn't done is made that change to actually phone the credit reference agency. So again, just going that little bit further. Now I've experienced for myself, it's a personal experience that I'll never forget. It could be something that really does make a massive difference between you coming from a high street lender approach when you're thinking, well, what the hell's going on here? Everything looks absolutely perfect for a high street deal, and you can't work out why the score's so low. Ultimately, that could be something that you can amend within 24, 48 hours with those reference agencies. So again, good things to know. If you start looking at some example credit reports here, so in this particular case, you've got a case that's or a client that's got a default. You start looking at when it was defaulted, if you like, and whether there's an outstanding balance. So in this one, it was October 2017. You saw the default that was given. Current balance is 1,623, no monthly terms. So ultimately, then you're looking at lenders to go, right, are you a lender that goes on the registered date? Does it need to be satisfied? Have we got a problem that is outstanding? And when was that debt given? How do you work this kind of information through? So Precise, Kent Reliance, for instance, we would go on the registered date. So this was registered in October 2017. That's long enough for us to have a look at this case, and it should be a case that we could do. From your perspective and the client's perspective, you then have some decisions to make. Are you looking to consolidate that debt? So do you want to put that 1,623 on top of the mortgage, maybe get them towards a high street lender in the future because they're still going to see that default is outstanding, or are you going to wait until it drops off the credit file within, I don't know, 6 years of it being registered? Those are the kind of conversations that are really important as part of your journey to help that particular client. So you can see you've got some figures here, 1, 2, 3, 4, 5, 6. So it's just got steadily worse, then it's gone straight to default. Second example here is slightly different, where you've got a client back in 2016 again, so a fair time ago. So again, this is still going to be a deal that Precise or Kent Reliance, for instance, could help you with, but it went 1, 2, 3, and then straight into default. And there's also a monthly cost with it. So 42 payments at a cost of £2 a month. So again, I'm not convinced this is exactly what it should be. I might be asking a few more questions. You can see there's an outstanding balance. You can see it's been defaulted, but has it been bought by somebody else? Is there maybe an arrangement to pay with this? Have they got into some kind of debt management plan? All these extra questions that could really support your client and understand why they've gone straight from a status 3 into default. So again, I haven't got all the answers, but these are just kind of things that might come across your desk, that actually they can go and have that conversation with that particular provider. So this looks a bit strange. I didn't realize you'd done this. Why have you done this? And it could be an error at their particular end. Other things to look out for when it comes to adverse credit. So a really interesting bit around where, again, the high street lenders look at things differently to maybe a specialist is when it comes to the big stuff, so secured lending, so missed mortgage payments. Now, that could be a second charge or it could be a first charge. So I noticed something recently on a credit report that they've started calling it a second mortgage. So rather than it being second charges, it's now a second mortgage. So again, help you out, help the client out to really understand that that's as kind of detrimental to their credit report as a first charge mortgage would be as well. So if you look on the left-hand side at the bottom, you've got 3 green dots. That's the latest 3 months, and that's showing they're up to date with their payments. Then you can see a 1, then a green, then a 1, then a green. Now, the ones are all late payments. So if I'm due to pay my mortgage on, say, the 1st of the month, and I make that payment on the 10th, maybe I'll get cash, or maybe I'm self-employed and money's coming in at different times of the month. I've still made that payment up within the month, but technically I have missed that payment. Now, for a high street lender, they're going to start worrying about this one and say, well, there's 1, 2, 3, 4, arguably 5 missed payments here. So that's probably not going to be one for them. Might have a massive detrimental effect to the credit score as well. But with a lender like Precise, we go on a worse status. So again, this is where a client might not even be approaching you because they think their credit report is in such a bad state that no lender's going to help, whereas actually you know that you can look at this as a worse status. They've never got more than 1 behind. Therefore, as long as it's up to date in the last 3 months, that is a deal that we could help with. Vice versa, if it was a bit further in history, if you like, if it was between months 12 and 36, we can actually allow a worse status 3. So again, that could have gone 3, 3, 3, 3, 3, 3, back up to date with a green. So they've made all those payments up, and now they've gone, again, 1 behind. That, again, could be something we can support with. So it's about looking at these reports and really understanding what's happened and why. Get people like ourselves, Kent Reliance, or any of your specialist lenders, get them on your mailing list. Drop us an email and say, this is what I've got. Is this something you can look at? We might tell you to do that decision in principle, but again, it's a soft footprint. It's not going to affect your client in any way. With Kent Reliance, for instance, we actually take that a little bit further. So lots of information on the Kent Reliance website to kind of support you with that one. But that, where they are slightly different from Precise, you could have 0, 0, 0 in the last 3 months as a status. Then you could have 1, 1, 1, and then 2, 2, 2, 2, 2. They've in essence up to date with their current status, and they've not been behind in the last 12 months. They've kept it on course, so therefore they've constantly made their payments, which is where they can get comfortable with the deal. And now they've made it right back up to date, now back on course. So again, just understanding how the different lenders look at these is really important, and there are subtleties between us. So again, lots of information there, but it could be something we can support you with. So that's kind of adverse credit to a certain degree, or whistle-stop tour of it anyway. It's really interesting from my perspective as well to look at specialist lending and go, it could be anything from low incomes, adverse credit, could be later life lending, which again, Precise are pretty good at when you come to buy to lets, but maybe not so good on when it comes to residential. There's lots of lenders that will support in different parts of this industry. Could be complex income, could have a client maybe that's only got income coming in from buy to let properties. They could have multiple jobs, multiple self-employed businesses out there. These are the types of deals that can really support, or the specialist lenders hopefully can come into their own. Could it equally be interest only? So both Precise Mortgages and Kent both offer interest only mortgages. Could be used in sale of property. And then I suppose the most interesting bit about this particular slide is nearly 20% of what we do in the specialist space is to the self-employed. So a really important part of our kind of DNA, if you like. Lots of figures around at the moment around the self-employed market. Anything figures kind of went up to about 5.2 million, maybe even a little bit higher as we kind of went into the pandemic. Then it dropped a little bit through it for obvious reasons. Lots of businesses, unfortunately, didn't quite make it. And then we're beginning to see it kind of increase again, where maybe people have made that jump from employment into self-employment. I think there was a recent stat that about 58,000 new companies have been started during the pandemic. So that ultimately means you've got 58,000 opportunities for those clients to come and see you that maybe have just got 12 months training figures or 12 months worth of figures to use, first set of accounts coming through. Is that something you can help with? A lot of the high street lenders insist on 2 years. But a lot of the specialists just say, yeah, 1 is absolutely fine for us. They might want to see a continuity of employment. So what were they doing before? They were a mortgage advisor in an employed position. Now they're self-employed. Absolutely fine. Precise Mortgages don't care what you did before. But again, as long as you've got those 12 months training figures, then again, we're good to look at that. Kent Reliance wants a bit more continuity with what you were doing previously. So again, that's where you've got the difference between the two lenders with us across the industry as a whole. So interesting to look at who completes a tax return. So your sole traders and your partnerships absolutely do. Your limited companies, limited liability partnerships don't. The reason I think this is important is because of this particular slide. So I did a few events over the last couple of weeks, and lots of lenders seem to do things slightly differently in what they want as proof of income. So Precise, for instance, you have a massive choice. Do you go down the tax calculation and tax year overview route, or do you go down the accounts route? So this is where, as an advisor, you might want both. Mr. Mrs. Customer, can you provide me with your tax calculation and overview, but also can you give me your accounts? Because the two might look completely different. You might have two totally different year ends. If I start my self-employed business in, I don't know, the middle of June, and I want 12 months to the next June, then ultimately that could look a little bit different to your tax calcs and overviews. It could be that, for instance, you'll want to use your SO302s and your tax calculations for 1920, for instance, so the year ending 1920. Ultimately, Precise and Kent Reliance can use those figures right up to the 31st of December this year. So in the year 2021, we can still look at your tax calculations and your SO302s from the end of that particular financial year. So they're pretty out of date, but we're happy to use them as long as the business bank statements back up what you're trying to prove as an income. So again, lots of flexibility, whereas actually the high street lenders or even some of the other specialists might say, no, October is the cutoff, or maybe even November is the cutoff. You're going to need the next set of SA302s, which might show a more tricky year in so much as they've not made as much money as the previous year, but they're beginning to get back on course to get to that figure. So again, that's where that flexibility comes into play and say, right, okay, I've got a lender that's got a slightly better rate, for instance, but actually they're not going to use those SA302, so therefore the loan amount might be smaller when you go into a lender like Precise or Kent Reliance. Again, that's where your skill as an advisor will just come into its own. Then you've got the complete opposite is, do I need to send you a set of accounts? So is that going to be important? Is that going to be more beneficial for that particular client versus sending in the tax calcs, the overviews, or the SA302s? So when it comes to accounts, then you start looking at, right, are they audited, unaudited, or are they full accounts? So we don't want to see draft or management accounts, but we can look at audited or unaudited, no problems whatsoever. And I want to try and kind of bring that to life a little bit with how we do or how we assess a case like this at Precise, but also Kent Reliance as well. Verification of a customer's accountant, really important. The ICAEW is a great website. So there is a specific website that you can search for qualifications of accountants, even specialities with what the accountants or those accountants or tax advisors can do as well. So for instance, you might need a tax advisor to support on the advice of a buy-to-let structure. Again, great website to help you out on that one. So when you start looking at a real kind of limited company set of accounts, important to kind of break these things down a little bit. So totally fictional, you might have heard of Roger Morris. He's our group distribution director, but these are fictional accounts. They're not, I haven't stolen from him, but ultimately I could have gone on Companies House and downloaded any set of accounts I really wanted to. So again, the options are there. You can go and start looking at accounts and just getting used to them, understanding them, and seeing how an accountant put these together. I think important to put a big caveat here. I'm not a tax expert. I'm not an accountant or a qualified accountant. This is just me looking at it from a lender's perspective and just saying, right, these are the kind of things we would look at. Every lender will look at this totally differently. But from the purposes today, just some real kind of quick ideas to say, actually, that could really help with my next case. So first and foremost, registration number. Right at the bottom of the page, you can see the registration number. That means you can jump straight onto Companies House and have a look at this particular set of accounts. You can also look at what's happened within that business. So have there been changes in directorship, shareholding, have people been added on, taken away? Could that affect what's going to happen with that business going forward? And that's exactly what an underwriter is going to do. They're going to see if there's been changes made. Has there been a new director added or taken away? Equally, you start looking at the year end. So 31st of January 2014, in this particular case, again, is that going to be important? Could there be a change of trading year? Is there other things that we can look at as well? And ultimately, have there been any new shareholdings added on? Is there someone that could actually have a detrimental effect to the profit that's being made because they've invested in that business, which could mean that shareholdings changed, which could mean so could the dividends and the salary payments that are coming out of that particular profit. Again, just a secondary page, if you like, you might see a little bit more information, see what's happened, see if there's any signatures. Again, just trying to support you with what's happening with that directorship and shareholding. Then you start looking at the first interesting page, if you like. So what are they turning over? So what turnover is going through that business? How is that business looking from a turnover perspective? What money is coming in to sell whatever product they've got? So I don't know, I've seen a petrol company, for instance, I did a mortgage for them a long time ago. The turnover was enormous. So much money was coming through that business. But actually, the bottom line figure, right at the bottom here, that net profit figure was really low. It cost them so much money to sell that petrol to get a tiny profit. Again, that could be a bit misleading, if you like. So, right, turnover is enormous. Where's all the profit going? Understanding that business again is really important as part of that kind of process. So again, really kind of interesting to look at this one. Then you start looking at the gross profit as well. So in essence, what's happening after they've spent the cost of sales? So they've got the money coming through the door. How much is it costing them to sell it? And therefore, then what's the gross profit? And then how much is being spent in terms of administration expenses to then get down to what tax they're paying on it, to then get down to what that net profit is, that bottom line figure. That's the bit that's going to really support understanding what's going to happen a bit later down the line in terms of what they could take as a salary, what they could take as a dividend, or are they retaining that money within that particular business? So net retained profit. Okay, so gross profit, very much the income left after deducting your direct expenses. Your operational profit is your profit, is the income remaining after deducting the indirect expenses from the gross profit. And ultimately, as I said, your net profit is that net of all expenses, interest and tax. Interesting to know there are certain lenders, I don't know if there's any about anymore, but some of them used to look at operating profit. Never quite sure why, because they've not paid any tax on that. But again, you might find different lenders look at different figures. And again, that might work out really well for you, depending if there are other lenders that look at things in a slightly different way. So again, just bring it to life a little bit with what direct costs are, indirect costs are. So your direct costs, your labour, your materials, your manufacturing suppliers. Your indirect is your rent, utilities, and your general office expenses. So again, might be worth knowing a bit more about the background of that business, how they're running it, what they're doing. Is that going to support the application that you've got? And then for me, balance sheet, really interesting part of a set of accounts, shows, I suppose for me, how strong that business is. So if you look kind of middle of the page, you've got 22,440 as your balance sheet balance. If you look at the bottom figure as well, it's the same figure. This is what's left within the business after they've taken any expenses out. And it shows, are they taking every penny of it out, or they're leaving a bit in there? Now you can see in the latest year, they have done exactly that. They've taken everything out because the balance sheet balance hasn't grown in any way. Previous year was exactly the same, 22,420. They've taken that forward. Again, it means they've still got that 22,000 to lean on if they need to, rainy day money, if you like. But ultimately, what does that mean? Is that balance increasing? And then you start looking at actually what can I use from an affordability perspective, start looking at remuneration, maybe director's car allowance, maybe even private health cover. And then really important piece for a precise perspective is that are they paying into a pension pot? So again, a really interesting way of putting your profit into something slightly different. So by putting, or this director or the two directors in this particular example, they're putting the money into a pension pot. That means they're not going to be charged that corporation tax to draw that money out of the business, maybe pay themselves as a salary or dividend. They can put that into their pension pot and not be charged the corporation tax. So it's a really cost-effective way of actually utilising the profits they've made, but it could have a massive detrimental effect on who they go to that mortgage or to get that mortgage, because could we use that as an income, if you like? So again, just bringing this to life a little bit. Talked about right at the top of the self-employed part of this section, if you like, we looked at an SIC 302 or a tax calculation. We're going to see on that SIC 302 and tax calc salary and dividends only. By looking at the account, now I'm going to see what they're taking as a salary, what they're taking as a dividends, might not even be within the account, but you'd see that on the SIC 302s. But what you will see within the account is what they're paying into that pension. So for precise, we would look at the salary, we would look at the dividends, and we would look at the director's pension contributions. So suddenly an SIC 302 versus what you'll see on a set of accounts, totally different scenario, totally different answer in terms of how much that client could be lent. You look at that again, there's other lenders out there, I'm sure that you'll come across them. They might look at salary and maybe net retained profit. You might have someone like Kent Reliance, for instance, that could look at maybe salary, dividends, and net retained profit, because they've been doing that for a number of years. They've been building that balance sheet balance up, and you might just need a small percentage of that to get across the line when it comes to affordability. There are going to be different ways to look at that set of accounts and see where you can go to maybe get that higher income multiple or get that loan amount that client needs. Again, I think Precise is pretty unique in this kind of example. We don't look at net retained profit, but we can look at those pension contributions. We can even look at a car allowance as well. So again, that's an interesting part. They might be paying for a car. They equally might have a car allowance that you want to add back as another income, maybe home office, etc. All those little incidentals that actually could support a slightly higher loan amount. Then you start looking at reserves. This is kind of an interesting discussion to be made as I'm recorded, Becky. So thank you for this one. So you've got someone that's got maybe taken their dividends, in this case 56,696. They're taking everything out of the business. So what you could find is that on this case, talked about your balance sheet balance at 22,320. They could equally take some of that out of the business as well. So the profit was 56. They've taken 56. but they had another 22 they could take as well. Now, if they did that on an SA302, you would show a very profitable year, but you wouldn't see that ultimately they've taken it from previous year's profits. So what I'm saying, being very careful with the words here, there is ways to present a case to a lender. So if you present this case to us using the accounts, we would see that they've taken money to support that mortgage application from previous year's profits. If you gave us the SA302s that just showed the salary and dividends, we wouldn't necessarily look at that set of accounts to know they've taken it from previous years. So presenting it, talking it through, understanding a set of accounts and understanding the strength of that particular business is going to really help with your presentation and the way that every lender will assess these types of deals. So again, just things to be aware of, and the way you present them to us is really, really important. Just a slightly different example here, but you can see a bit more detail with director's salary, director's car allowance, got the pension contributions in here. You've got even a vehicle leasing costs. So what you don't want to be doing is double counting it, for instance. So is a lender taking the vehicle leasing costs as a personal expense, but actually the business is already paying for it. So therefore, you shouldn't have to include that as well. I mentioned the use of a home office. That could be another addition, if you like, to how precise we look at it, not necessarily how some of the other lenders would. So again, different examples. So then we start looking, right, we've looked at a set of accounts. We've looked at the difference between maybe an SA302 set of accounts. Then you've got Kent Reliance, which do things even more differently, if you like. So Kent would look at a projection. So this is where you've got someone, and I always revert back to some of the high street lenders that just won't support a self-employed client unless they've got 2 or 3 years figures. Kent Reliance, Precise, could do just 12 months, but we can also look at Kent Reliance slightly differently, because we can look at 12 months plus a projection from an accountant that's had a relationship with that client. So let's say you're a mortgage advisor, you're employed, you've gone into a self-employed situation, you want to buy your first property with your partner. Your first year's trading was 50K. You're 6 months into maybe year 2, and your accountant who's been working for you for years, you've known them really well, they're willing to put a projection to us, the lender. Now, year 2, with all the prop fees that are coming your way and all the protection income and commissions that you've got coming your way, is looking like 100K a year. So brilliant uplift there. Kent would look at a 30% uplift on year 1. So we've got in this example, Mr. that earns 36. They go, say Mr. walks into a high street lender and says, right, we can use your income because you're employed, can't use your wife's income because unfortunately she's only got 1 year's trading figures. So maximum loan 161. Come to someone like, I don't know, Precise Mortgages, they'd go, right, we can look at your 36 plus your 50, then you're looking at a loan amount close to 386. Go to someone like Kent Reliance, well, they're looking at a 30% uplift on year 1, plus Mr's earned income, suddenly you're looking at a loan of 450. So again, totally different scenario by coming to a specialist lender to working out where you might have walked into a high street and only got 160, you're now getting 450. It's a massive, massive difference by coming to you as an advisor. And these are the kind of scenarios that you could easily put these on your website and it's going to generate business, because ultimately no one is going to be shouting about this kind of stuff. These are live examples. We've done these in the past. We can continue to do them. This could be something that can really help grow your business. So I just want to move towards the buy-to-let side of what we do, but some really interesting statistics about what happens if you are self-employed. Where do people kind of put their money? So yes, the majority, if they are self-employed, they invest in property. Now, I did get a bit carried away with this. It's not just buy-to-lets. They do buy residential property as well. But ultimately, it's a good way of knowing self-employed people really do want to invest in property. They want to buy their residential properties, but they also want to invest in buy-to-lets as well. They also invest in pensions, which is brilliant because of the example I've just given you with what we do at Precise. There could be solutions to say, actually, it doesn't matter that you're putting all your money into your pension pot. We can still find lenders that can support and use that income or use that expense, if you like, to support your mortgage application. So important to know that you could get follow-on leads on the basis of supporting a self-employed client in different parts of the industry. So there have been, to put it mildly, some changes in the buy-to-let sector. Lots has changed. It could be the creation of ASTs or short-haul tenancy agreements, making it a bit more profitable for landlords. It could be back in 2004, the kind of introduction to a classification of property, so resi, semi-commercial, HMOs, commercial lending or commercial titles, if you like. Again, just kind of tightening up what we do and how we do it. Then George Osborne made some nice changes in his budget 2015, which are beginning to kind of come to fruition now. And I'll go through that with you in a second. Then we had some additional stamp duty changes, which really kind of affected the buy-to-let market. Lots of 5-year deals that were given at this time are beginning to come off of that 5-year rate if they haven't already. And you've got landlords that didn't realise there's been changes to the way that lenders affect or look at and underwrite a portfolio deal. Or equally look at the way we stress the affordability of a buy-to-let, and equally EPC changes, HMO licensing changes. So you might find that a landlord that bought something in 2016 because they didn't want to pay the extra stamp duty, suddenly things are beginning to happen and change, which could now mean that new application that you're having to deal with is totally different from their experience from 5 or 6 years ago. So again, important to give value to what you're doing. A landlord might not know it. You're having to do all this information, search and research, give true value to it, understand and explain that the market has changed dramatically, that you'll be able to support them in that application. PRA changes, absolutely really important part. I suppose it's important to let you know that not every lender is affected by the PRA. There are non-PRA regulated buy-to-let lenders. So when you hear maybe a lender that's talking about not stressing a portfolio, that's because they're not affected by these rules. So there are going to be different ways different lenders assess a portfolio case. So a portfolio landlord is someone with 4 or more mortgaged buy-to-let properties. So again, just things that you might pick up. Again, you might find that you've got a landlord that's got a portfolio and there's immense stress on that portfolio. It could be high LTVs, it could be low rent, it could be something that actually someone like Precise or Kent Reliance can't do. But you might find that a non-PRA regulated lender could do that deal because they're looking at the one that you're putting together in complete isolation. Is it the right thing to do? Well, that's up to you and your landlord to work together, but there's going to be different stresses and strains that the regulator is trying to put onto us to say we don't want to put that landlord under more undue stress. So that's some of the reasons. But again, we'll cover that a bit more in session 2. EPC changes, lots of information in the press about this at the moment, talking about EPC ratings going up to the C. It's going to be scary if we get to that position, but at the moment, if it's an F or a G, it's a fail. Again, that could affect that landlord and what they're trying to do. And equally, the HMO licensing laws, which came in 2018. Again, we'll cover a bit more in session 2, but really kind of affected our industry and kind of how landlords, if you like, rent property out. So I think mortgage interest tax relief is probably quite a topical one because it's really going to come into full effect in January 2022's tax return. So again, this is where it falls nicely with the self-employment piece as well. I think my easiest way of describing this is that unfortunately, whenever money is made, there is always a tax bill to be paid. Now, the rate of tax you pay is going to be dependent on the income you earn. As you know, anything from 0 to 45%. But from April 2017, landlords used to be able to deduct all of their mortgage interest payments from their tax bill. And this meant that they could then only be taxed on the profits they made, not the turnover. But from April 2020, and this is why we'll see it in the January 2022 tax return, it's the turnover or rent, to put it in a better way, that will be given, and you'll only be given a tax credit of 20%. So again, bring it back to reality. Your basic rate taxpayers, your 20% taxpayer is not going to be affected, but your higher rate and additional rate are absolutely going to be affected by this. So any rent that landlord is receiving, if they're a higher rate taxpayer earning 50,000 or more, it's going to have a massive effect on that tax return, and it could mean that buy-to-let property is underwater. So again, just worth knowing, worth understanding it, alongside some of the other changes, including stamp duty on second homes. Got some ideas on that in a second, and the way that we kind of underwrite deals. So it is a bit of a whistle-stop tour, but ultimately, when you come to who you are and where you fit within a buy-to-let part of our marketplace, you are the key part. You're the mortgage advisor. You're going to have a client that's going to come to you, but you need to know kind of where you fit within this. Are you working with the right accountant, the solicitor, the tax advisor, and the letting agent? So for me, the interesting bit about this one, your accountant always looks back in time. So we've talked about it already. You've got that set of accounts. All it's doing is illustrating what happened previously. Your tax advisor on the complete opposite side, if you like, is the one that's going to help support and structure the deal going forwards. So if I'm buying a buy-to-let, even if I'm a first-time buyer, first-time landlord, I want to be getting tax advice because that's what I'm going to do for the next 10, 20, 30, 40 years of my life. I need that tax advice. Your accountant, you're going to come to in a year's time and say, right, last year I rented the property out. What tax am I due to be paying on that? That's where they're going to help with those set of accounts. So tax advisor, future person, accountant, the one that's looking back in time. Then you've got people like your letting agents that are going to support with getting that rent in, understanding the local area, and your solicitor will help with the structure of ownership. If it's a personal ownership case, for instance, could we structure it in joint tenants or tenants in common? Again, that's really important from a setup perspective. Again, the tax advisor will help on that part as well. But if I've got a high rate taxpayer and someone that's maybe got no income whatsoever, I might want to structure that in tenants in common, 99% to one, 1% to the other person that's not earning any income. That could work better for me from a tax position than it could do having a 50-50 ownership. So again, things to think about, but making sure that you're not giving that advice because these people are going to do that for you. So yes, we can do all types of landlords at Precise, Kent Reliance, but at Precise in particular, we can take someone right through from a first-time buyer, first-time landlords, their known residential property, their first purchase is going to be a buy-to-let, right through to your older landlords that have got a portfolio of, 100, 200 properties. Whatever fits in between, we can have a look at. So this is just a bit of an introduction to say this has been one of the most searched bits of criteria for the last 12 or so months, probably a little bit longer now. But first time buyer, first time landlord looking to get on the ladder, need a lender that's going to allow them to do that. I want you to be thinking about business plans. So ultimately, are they looking to set this up as a limited company structure or personal ownership? Some great lenders out there that would set this up in personal ownership. So generally speaking, your NatWest, your Barclays, Clydesdale, they would all do first-time buyer, first-time landlords, but they wouldn't allow you to structure it in a limited company structure. That's where, again, you're going to be the best advisors because you're giving them or passing them over to that tax advisor to give them that advice on ownership, and that's going to help with what you're looking to do. Precise Mortgages can allow you to set this up in limited company structure or in personal ownership. Why is that important? Well, it just means you could have a situation where, I don't know, in 2 years' time, that particular, in this case, Scott comes back to you and he says, right, I'm now ready for my residential purchase. But because he did that first purchase with NatWest, for instance, now he would have the secondary stamp duty to pay because he's already a residential homeowner. With Precise, if you set it up in a limited company structure, ultimately that's a separate legal entity, so he wouldn't have that additional 3% stamp duty to pay. So again, this is where you're working with solicitors, you're working with your tax advisors, you're working with your lenders to make sure the right deal is on the table for someone like Scott. Other things to look out for with first-time buyer, first-time landlords, distance to where they currently live to where they're looking to buy. We don't want it to be a backdoor residential deal. It's the only buy-to-let mortgage that Precise will look at affordability. So it's the only one we look to see actually could Scott afford this if he were to move into the property. If he wants to reinvest his profits into future purchases, again, no problem. But again, am I starting to think, right, he might become a portfolio holder later down the line? Have I put him in touch with those tax advisors to make sure that they are getting the right tax advice? And again, the light bulb moment, plans to buy that residential property in the future. Have you had that discussion about stamp duty, that additional stamp duty that could come, and how are you going to structure that deal, again, in partnership with those tax advisors? So things to think about when it comes to that. If Scott, for instance, does set up a limited company, so again, very simple to do that, can just jump online and set up a limited company. At Precise, Kent Reliance, we need personal guarantees from the directors. We also need them at Precise on shareholders. Kent Reliance, a bit more flexible around that as well. But you could even, say my scenario, I've got 2 children, aged 6 and 10. They could be 100% shareholders of my limited company. So very, very interesting to see how you can set a limited company SPV structure up. So limited company SPV, specific purpose vehicle for buy-to-let property. Now, equally, we've talked about limited company, self-employment, and what I'd call a trading business. So you're mortgage advisors, you could have a hairdressers, a dog grooming business, whatever it might be, they are a trading business. Now, at Precise, we don't lend to trading businesses, but what you could do is, as we've seen from our example of company accounts there, they had about 22,000 sitting within that business in their balance sheet. Now, they might want to use that as a deposit to buy a buy-to-let property. There are lenders out there that would lend to trading businesses. We don't do that. But what we would allow them to do is take that money out as an intercompany loan to set up a newly formed limited company SPV, specifically for buying buy-to-let property. Absolutely loads of information on the Kent Reliance and Precise website about intercompany loans. What I'm trying to say here as a bit of an intro is that there are solutions and options for clients. So if a client comes to you and says, I'm desperate to buy a buy-to-let, I've got loads of money sitting within my current self-employed business, again, give yourself some time. There are lenders that lend to that trading business, but equally, it might not be the best thing for that particular applicant. So talked about it already, but could be a new company, doesn't need to be an experienced landlord because we can accept it for a first-time buyer, first-time landlord. We need certain SIC codes, so standard industry classification codes, to understand that this particular limited company, SPV, has been set up for, in essence, letting property out. Again, I was talking to one of the underwriters at Precise recently about this. So this is one of the top 5 reasons we decline buy-to-lets at Precise, is that they've got the incorrect SIC code. They've either added too many, or they're looking to do a remortgage, and maybe they used to be a slightly different company in the past. Maybe they were a building business, maybe they built some property, and now they're looking to turn it into a buy-to-let. Again, this is something you can get by going onto Companies House. You can go onto Companies House, you can look at the number of that particular company, as I mentioned right when we first started looking at those sets of accounts, to see what SIC codes are associated with it. Any company that was set up after June 2016 will have that SIC code. So this is where you can just add instant value. The last thing you want to do is put a case into someone like Precise or any of our competitors, and you don't get this assessed until full application stage, and they say it's got the wrong SIC codes on it, we can't help you. It's just a total waste of everyone's time. Kent Reliance, a lot more flexible. So they would look at more SIC codes, they can be more flex around it, Interbay Commercial even more so. So again, it might be that you have been declined by another lender, don't necessarily write it off, but understand that you might have to go to a slightly different lender to get the answer that you really want. Again, knowledge is key. Understanding what SIC codes you've got with that particular business is going to help to see if we can support. A couple of other just examples, mention stamp duty and the effects of that secondary stamp duty is having on our marketplace. It could be that it's affecting the let to buy market as well. So probably a lack of properties on the market at the moment. Maybe if you were to try and put your house on the market, it's going to sell pretty quickly, but there are equally times when it's the complete opposite to that. And that's where we start to see let to buy kind of come into its own. But for argument's sake, we've got lots of people that are in city centres, in towns, that are maybe looking to retain that property and then move outside, maybe get that garden that they need or the land they want, but they want to retain that existing property as a buy-to-let. So they will be put off naturally by the stamp duty charges, that additional 3%. If you got this example, so they've got a £100,000 flat, want to retain it, and then want to move up market to a £300,000 property, they're going to have that 3% extra stamp duty to charge, so an extra 9k worth of cost, if you like, a bit of a turn off. An example that could support someone like this, or again, just something to have a chat about, is that you've got someone that's got that £100,000 property. They could look to sell that to a newly formed limited company SPV. So that newly formed limited company SPV buys the property and they'd pay the appropriate stamp duty to purchase it. So in this case, £3,000. They've now got to structure it in a better position in terms of something we haven't talked about today, but ICR calculations, so interest coverage ratio calculations, that depending on the structure you own a property will depend on how much we have to put stresses and strain against that property. Now, for a limited company structure, it's the best ICR in the marketplace. So that could mean they could raise more money against it to go and put towards a deposit on the residential purchase. Now, again, the couple of interesting bits as well is that because of that selling from personal ownership into a limited company structure, now I've got rid of that from my own personal name. So that residential property purchase doesn't come with the additional stamp duty. So again, there could be a saving involved in that. It's really important to note, again, I'm not a stamp duty expert, nor am I a tax advisor, nor am I an accountant. So again, it's understanding that you're having these conversations with the right people, but ultimately these are things that we've seen happen that could result in it being the right thing for that customer. Doesn't always work. The higher the value of the properties, sometimes there is a tipping point. So again, just important to know that these are just ideas. Then you start looking at increased rental yields, which we will cover in our second part of our kind of buy-to-let section of what we're doing with Becky and all the guys at HLP. But it could be HMOs, it could be multi-units, it could be adding value through refurbishment of buy-to-lets as well. But in essence, we're there to support you. So sales teams at Precise, Kent Reliance, and Interbay are all there, all available to have these kind of conversations and add real value to your business. We've covered a lot this morning. We've looked at self-employment, we've looked at adverse credit, we've looked at a little bit around buy-to-let, but I hope it's given you a bit of an overview about what we can do, how we can do it, and hopefully support you with writing a bit more business. So Becky, I will pass back to you. I'll have a little rest, and if there's any